Hi, my name is Thomas, and I'm here with Bones Realty out of our Atlanta office, here to talk to you about a question we've been getting a lot from our investors recently. And that question is, what should we expect as investors coming from the housing market in 2021 and beyond? Is it going to be a repeat of 2008? Will it be a totally different animal, or will we see housing prices continue to climb? The quick answer is, I don't know. We don't know. But what we do know is that history is a funny way of repeating itself. So because of that, we took the past 20 years of market data, we sorted through all the numbers, and we pulled out a couple key trends that we think will help you to make a better buying decision in 2021 and beyond. To start with the story, we need to take a look at 2001. Now, this is the beginning of the recovery from the dot-com bubble crash. On the bottom in the yellow bar, you're going to see a lever. Now that represents interest rates being cut. This is something that the government does to encourage consumer spending anytime that the economy takes a dip. But keep in mind, this is artificial. Now, if you look at the green bar, paired with this, we had mortgage lending relaxed. If you've ever seen The Big Short, this is what preceded the 2008 Great Recession. What happened was mortgage brokers were lending out mortgages to homeowners who weren't qualified. They weren't checking their qualifications to see if they could afford these homes. Another problem that compounded with that was that a lot of these were adjustable rate mortgages. You might have heard them referred to as ARM mortgages. And all that means is that your monthly mortgage payment is directly tied with interest rates. Now that made a lot of sense between 2001 and 2003 when interest rates were declining. But as soon as those started hiking up, people started having to pay more and more and more on a monthly basis, and it started getting to a point where they could not afford their mortgage payments. So you'd probably say, well, Thomas, why don't they just refinance, and then they get a locked-in rate that they can afford, and that's reliable. The problem there is, paired with all this, we see housing prices start to decline. Moving on to 2008 and the Great Recession, we see a significant dip in the housing market. And that goes on for 4 years. We don't bottom out until 2012. And then again, we see the government artificially inserting themselves in the market between 2008 for 6 years to 2014, cutting interest rates to, again, hopefully encourage consumer spending. I want to take a pause here and take a look at a snapshot of 2008. We look at jobless Americans, and there are 11.1 million jobless Americans at this point. And if we take a look at home foreclosures in 2008, we're looking at 3.1 million. I'm going to jump over the all-time high. I'm going to go right to supply and demand. Because the mortgage lending was so relaxed, demand for homes went through the roof because so many buyers who would have previously been unqualified now entered into market to buy. This caused a discrepancy between supply and demand, so it's not so much that supply dropped, but it's that demand went through the roof. This caused an all-time high for home prices in 2005. So keep this in mind as we examine the next 8 years. This is important, and we're going to do a comparison of 2020 as well to give you an idea of where we might be at from a historic standpoint and what we might be able to expect. 2013, we see mortgage lending again become relaxed. Now, not to the level that we saw in 2001 to 2005, but the government does make it easier for your everyday American to purchase a home. So the economy is going so well during this period, we see the United States hitting an all-time economic high for the strongest economy in the history of the world until that point. So how does the government respond? Well, they insert themselves artificially into the market by cutting interest rates in 2019 to try to boost the economy again. Why did this happen? It's not for this video, but it's just important to understand anytime you see a yellow bar with the interest rates being cut, that's the government artificially inserting themselves into the market cycle. What happens in 2020? I know many of you are watching in 2020, probably 2021 as well. We see the COVID-19 pandemic, which causes a tremendous amount of uncertainty in the market. How does the government respond to this? Again, we cut interest rates, but they had already been at a low from 2019, so they're at a historic all-time low as of 2020. I want to take this into a snapshot and compare it next to the 2008 snapshot. We saw 11.1 million jobless Americans. As of November 2020, we see 10.7 million Americans without a job. But then there's something interesting. We see foreclosures in 2008, but it says forbearance here in 2020. Why is that? Well, the government learned something from 2008. Part of what caused the global economy to crash was foreclosures. So the government, again, artificially inserts themselves and they say, hey, we're not allowing any foreclosures to happen during the COVID-19 pandemic. And we're forcing mortgage lenders to accept forbearance. Forbearance means that your mortgage lender allows a homeowner to not make any mortgage payments for an agreed upon amount of time. And then at the end of that amount of time, they can settle up with their mortgage broker. The government did step in to try to stop a bunch of home foreclosures from happening because of all the market uncertainty and job loss that's happening during the COVID-19 pandemic. If we take a look at supply and demand, what we see is unless you absolutely need to sell your house, a lot of home sellers are sitting on the sideline because there's a lot of uncertainty caused around the COVID-19 pandemic. Demand, we don't really see diminished. As a matter of fact, in some areas, it increases. This starts causing what we will soon see as home prices hitting, again, another all-time high for the first time since 2005, because demand for houses is way up. Supply is less than usual because of what we just talked about. People aren't moving unless they absolutely have to do so. One thing that's important that I think that needs to be noted before moving on from this is 2008, real estate was the cause of the market crash. In 2020, consequence of the market crashing due to the virus. So in 2008, real estate caused the decline in the economy. In 2020, COVID-19 is causing that decline in the economy due to uncertainty. All this information, what does that mean? I certainly do have a theory. Bones has a theory of where we think that this is going to go and how it's going to affect our purchasing in the market from 2021 and beyond. And if you'd like, I can share that video with you if you go to our website, bonesrealtygroup.com. If you sign up with your email address, I will shoot you immediately a video on our theory of where we think the market is going and how we're going to invest in the future, and then how we would also instruct you to do the same. So thank you for watching. I hope this can help you make a more informed decision 2021 and beyond. And follow us on our website for more updated news as it comes out.